Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Friday, December 1, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Quite the day today. Last night, we talked about an important price level, 260.66. That happened to be the low of the breakout candle. I went into detail on why that's important. Markets like to come back and retest or check in at former breakout and former breakdown areas. Today was evidence that that's exactly what happened. Now, when the market broke down, it broke down on a news event, and whether or not you believe or disbelieve, whatever the news is, doesn't really make any difference. We had Michael Flynn apparently going to testify or have evidence that Trump was implicated in his dealings with Russia. Who knows what the story is? Who really cares what the story is? The market drops on a piece of news like that. Then we get another piece of news crossing the wire that all of a sudden North Korea wants to sit at the table and have negotiations in terms of their nuclear program and all that stuff. Whether that was fake news or something else is fake news or real news doesn't really make any difference. The point is that when the market declined, look where it stopped. That's the only thing that's really important. The market trades based on technicals. It may get a spark based on a news event, but at the end of the day, it's going to trade to certain areas and find support, or it's going to trade to another area on the upside and find resistance. That's just the way the market works. When things are quiet or when there's nothing that sparks the market in one direction or another, it trades in patterns. It goes up, consolidates, goes up again, goes down, consolidates, goes down again. But at the end of the day, the market continues to do the same thing over and over and over again. This isn't rocket science. How did I know that the likely scenario was if we came down toward the low of the green candle at 260.66? How did I know that that was going to be at least, at a bare minimum, temporary support for the market? It's not that I know anything in advance. It's just that we've seen this happen over and over and over again. Therefore, this is the way the market works. If you look at a chart and you pick out all the highs and all the lows on whatever time frame you want, hourly chart, 5-minute chart, 10-minute chart, 240-minute chart, daily chart, makes no difference. You'll see certain things repeat over and over and over again. Not every time, but when you see something enough, you begin to understand that this is the way the market works. When the market trades in certain patterns, when the market has certain resistance or support levels, when the market tests certain levels, breakout candles, lows of breakout candles, and highs of breakdown candles, and it happens in every market, every stock, every time frame, doesn't make any difference. It's every single chart. You begin to understand what to look for, and when you understand what to look for, it gives you an added confidence when placing a trade, placing an investment. You have an area where you know there should be support or resistance for the market. You know where you're wrong. If that area is broken, and the market will probably go to the next stage lower, and so on and so forth. And that's the way the market works. This is the way I teach. I teach all these different technical attributes that I've accumulated over the years, and these are the same things that repeat over and over again. Nothing's 100% of the time, but certainly the way in which I teach, the way we view the markets, has a high degree of success. So let's get back to the SPDR, or the S&P 500, and at the end of the day, the S&P was down 5 points. The SPDR was basically down 30 cents. Not a big deal one way or the other. We were certainly down a ton earlier in the day, but we bounced off that level. We actually came up 10 cents short. I believe the low of the day was, 260.76. So we came up 10 cents short of the actual low of the green candle, which is a breakout candle. And then the market hit like a trampoline or a springboard and just went higher, consolidated a couple of times during the day. But at the end of the day, we finished basically near the highs of the day, almost like nothing at all happened. Now, let's talk a little bit about expectations for next week. So Mondays are generally quiet. Unless we get some kind of a geopolitical event over the weekend, you'll likely get a quiet opening on Monday, and we're not sure exactly, what the story is going to be on Monday. However, what I do believe is going to have happen, or what I do believe is going to happen, is I think we're going to make at a bare minimum of another retest of where the lows were today. That's normally how the market works. Whatever the reason was that we went down, at some point over the next several days, some other reason or a resurfacing of the same reason will resurface, and the market will take another dip lower and take a retest or do a retest somewhere in the neighborhood of today's lows. Now, if they hold, that will be bullish and we can go higher. If they don't hold and we actually close below today's low, that's going to be bearish for the market. So my expectation for next week at some point, maybe it's Tuesday, maybe it's Thursday, I don't really know what day it's going to happen, but what I do know is at some point next week, the probabilities say that we're going to see an attempt at a bare minimum of a retest of today's lows. What takes that off the table? A close above yesterday's high. If we close above yesterday's high, everything I just said is off the table. Until and unless we close above yesterday's high, that retest is on the table. So in the short run, unless we have some kind of geopolitical or other related news event that jolts the market over the weekend, my expectation is we'll probably have some follow through early Monday with some higher prices. Maybe we get up to 265, even 265 and a quarter, 265 and a half. Closing the day above yesterday's high is really the key. Unless that happens, another retest of the lows or close to the lows from today is coming next week. Same scenario in the IWM, of course, my favorite leading indicator of the market, and it's really the same story, so there's not much to pick apart with the IWM today. The only interesting thing is where we stopped short today. We stopped short where the 20 and the 50 period moving averages are, which are the blue and the red trend line, and that's exactly where we stopped, reversed today, just like we did in the spider at the green candle low. Today, we stopped at the moving averages. There's really a convergence of the 50 and the 20 period moving average. And remember yesterday, I said price is going to have to come back down toward the moving averages, or moving averages are going to come back up to price. They're getting too far extended, and in one fell swoop, we hit the moving averages. But all in all, we're still extended at the close today from the moving averages. Just because we touched it for a couple of minutes and springboard off that level doesn't mean that we've really satisfied the overbought condition. Another retest across the markets is likely next week. The same goes for the IWM. Not a different story. It's going to be the same story. All markets will likely trade together. Now remember from last night's video, we talked about the VIX. And it was interesting because the VIX was rising as the stock market was rising, and there was something that wasn't right about that picture. We've seen that before. We've read that book before. It's kind of one of those scenarios where the market was sniffing something out ahead of everybody knowing what was going to be the event that sent the market in the other direction. And I said either the VIX is going to catch up to the market, meaning the VIX is going to go lower and as the market goes higher, or the market's going to come down and catch up because the VIX has been going higher. Well, you saw what happened today, and look at the spike we had today in the VIX. We came back up to test a double top area, so right here is where we found resistance. That level was from the 15th of November, so basically 2 weeks ago. We had a down move, we made a low, we had a bottoming tail, and we had a complete reversal in the other direction, retested the highs from 2 weeks ago, and collapsed down all in one day. This is some spike and collapse all in one day, obviously coinciding with the market going in the opposite direction. Remember, this business is about reading the charts, and the charts are always trying to tell us something. The question is, are we able to decipher what the charts are telling us? And that's why we look at various markets. We look at the VIX. I look at the IWM, the transports, the spider, other markets, because the markets as a whole, various different markets, are always telling the story. The question is, can we decipher the story? And the VIX was telling the story over the last several days. Let's move over to the transports. and the transports had a huge decline today at the lows. When you take yesterday's high to today's low, that's over 300 point swing in less than really a trading session, because this happened earlier in the day, the drop down. Still finished down 88 points on the day, a little bit less than 1%. So that's a decent down day for the transports, but we talked about this yesterday. We had 3 big up days in a row. It just wasn't going to continue going into the stratosphere, was going to have to come down to planet Earth. Today was that day where we finished down 88 points, which isn't a big deal, but to have a 330 some odd point swing from yesterday's high to today's low, and after the last 3 days of upward activity in the transportation average, it's really a wild index. Certainly uncharacteristic for the transports, but if we do pull back next week and retest the lows, as I suggest we will, expect the transports to come down right along with the rest of the markets. It would be uncommon, or uncharacteristic, I should say, for the transports to make new highs without at least consolidating for a while. Even if the market's going to make new highs, the transports are extremely overextended, and like all the other markets, they need to eat some time off the clock and let the moving averages come up into price, or let price come down into the moving averages. That's my expectation for the transports. I think price will come down toward the moving averages to work off some of the overbought condition. Real quick tonight, we'll talk about the triple Qs. The reason why I want to talk about the Nasdaq is because on Wednesday, when we did have that one-day decline, that enormous decline in the Nasdaq composite and across the board, all the technology stocks, the question was that a true market reversal, and was that going to be the sign of more downside to come? It's starting to look like evidence that that was, essentially a shot across the bow, just like the VIX was a shot across the bow. Again, it was another piece of evidence that the markets always are telling us something. The question is, are we able to take that information and A, act on it, B, decipher it, and C, be correct about it? It's not easy. It's just a function of how markets work. Tonight, we'll also take a look at the XBD, or the broker-dealer index, and primarily because you look at the spike down that we had along with all the other markets in the broker-dealer index, but look where we finished. We finished up $1.67, or about 0.6%. And you know what I always say? It's unlikely that the markets will decline without the financials, and it's unlikely that the market can rise substantially without the financials. The financials are going to lead the market, not necessarily as a leading indicator, but they have to participate in either direction, on the upside or the downside. And today, the huge bounce back in the financials and the fact that they finished positive in the broker-dealer index, and the XLF finished slightly above the flat line today by a nickel, but the fact that they finished positive tells me that there's probably some upside for the market early next week. That's one of the clues or pieces of evidence that I'm taking away from the close of today. It's always the close that's important in markets, not necessarily how they trade during the day, certainly not as much as how they close them at the end of the day. Switching over to the gold market, you can see what happened here. Gold traded higher earlier in the day, right up to where the 100 period moving average at 1292. Very difficult market to get a read on. Looks bearish, then it reverses one day, and it reverses as the stock market meaning, is coming down, gold is going up, quote unquote fear trade. Whatever the case is, there's no clear signal, no clear pattern of anything that we can take advantage of from an eyeballs perspective on the chart in the gold market. So with that being the case, we just leave it alone, and when the picture clears up and the chart is telling us a clear signal of what the next likely scenario or likely move is going to be on the up or the downside, that's when we'll be able to take some action. But right now, hovering above the 200 period moving average for as long as we have, up a few dollars today, is not that big of a deal. There's still the pressure, or the probabilities are pointing to the downside, but it's not a high enough probability to take a trade from, because we just can't seem to close below. We can't seem to break and close below with any meaningful conviction the 200 period moving average. It seems to be very, very supportive of this market. There's two things that go on. Either you beat on it long enough where they're just going to break down the 200 and gold's going to bust through to the downside, or that doorway is just locked it's a steel doorway. They can't get through and they'll just head in the other direction. And maybe today was the first sign of that, but it's way too early to tell. We need more evidence, and next week we'll get some of that evidence. By the way, we did roll into a new contract month for gold, the February contract, and I adjusted some numbers. I did some additional work on gold, and we have two levels on the downside. The first level of support is right around 1255 now, slightly higher than it was before. However, if we got a really hard sell in gold, it could actually come all the way down to about 1229, 1230. That's the bottom green line that you see. We'll talk more about that next week, but I just wanted to make sure that I pointed that out. Going to the silver chart, look at that 16 spot 444 level. This pivot low is still holding. Yesterday we closed above that level after trading through it during the day, but we closed back above that level at the end of the day. Today, we did the same thing. We spiked down, but they rallied it back to close above that level. That's an important level. This is the market's way of telling you just how important that pivot low is. And here's another piece of evidence that we may be in for at least a short-term bottom in silver. So from this pivot high here, okay, till today, this was the 10th day of trading activity. Anybody that's taken my course or has listened to me long enough knows the importance of that figure and why today could be, at least for a short-term basis, an important low in the silver market. How about crude oil? The 20-period moving average is holding in crude oil. We are in an uptrend. All the moving averages are trending higher other than the 200 period, but the 20, the 50, and the 100-day moving average are trending higher and they're getting stronger. So they're widening. In between the 20 and the 50-period moving average, you can see the space between them getting wider. That's a bullish sign. That's telling you that this market is bullish, and I wouldn't necessarily bet on the downside in crude oil. This is a bullish market, wants to go higher. We know there's a lot of resistance in and around that $60 area. However, if we bust through that area, the reason why it's so important in and around that $60 area is because if we actually did get above that area, there could be significantly higher prices coming in crude oil. So I'm watching it very closely. We're not at the $60 area, so we don't need to discuss just how high, but we could get up into the 70s, and it's not all in one shot, of course, but we can get up into the 70s. There's stops along the way. There's resistance points along the way, overhead resistance. But at the end of the run, we could get up into the 70s, which would represent an opportunity, to get short crude oil. I'm not necessarily looking, unless we got the signal of a reversal or the signs of a reversal. I'm not looking to get short at 60 right now. I'm looking to see what happens at 60 first. If we trade up to 60 and we begin going sideways around $60 a barrel, that's going to be the first signal that higher prices are coming. Right now, this is, on a daily chart at least, in a bullish uptrend, and it's telling us higher prices are coming. We've been talking about that for quite some time. Higher prices have come, and it's still telling us higher prices are coming yet. The trend is your friend until the very end. On the bond market, we had a nice big healthy update today in the bond market. We only had basically 2 days of downside activity. The bond market was higher today. It still supports my case that higher bond prices are coming. Now, today we took a peek above the resistance point that has proven to be such a big resistance point right in this area here, and it comes from different reasons, multiple reasons. You have the red candle high here, the breakdown candle, and today we took a peek above it. Weren't able to close up there, but I think that was a shot across the bow that they're going to continue to try and close above that level. So we'll see what happens into next week. Right now, the bond market is still doing exactly what I thought it would do, which is try and work its way higher up to that 157, maybe even 158 level before the longer-term bearish pattern begins to play out. This could take another few months. That's completely possible. But the absolute hurdle in order for that case to play out is we have to get above on a closing basis, daily close, above this level. If we do get that close above this level, then I think that double top comes into play. We've been discussing this for quite some time. Nothing has changed from my longer-term outlook in the bond market. On the dollar is struggling. It is making a bearish pattern. We are below all the moving averages. Right now, the chart is telling me the dollar wants to go lower until and unless we got above, at least to start, the 100-day moving average. Then we have to really get above this red candle high right here. Until and unless that happens, and that includes the 20-period moving average, which is the red sloping trend line, and the 50-period moving average is the blue trend line. Until we got above these areas, the pressure is really to the downside. This is a bearish pattern. We made a down move. We're consolidating sideways. This plays out to the downside, at least 7 plus maybe 8 out of 10 times. So right now, the probabilities favor more downside in the dollar. If we move down in the dollar, we would come down to retest this double bottom area. And if that didn't hold, we're back in business into the 87, maybe 88 cents on the dollar area that we were talking about before when this move reversed. That's where we were looking for before. We were looking for 87, 88 cents on the dollar. If we come down again and break this low, we're going to be looking for the same numbers on the downside. When everybody gets maximum bearish, when we break 90, for example, if we get down there and they break 90 cents on the dollar and everybody gets extremely bearish the dollar, talking about a dollar collapse, buy gold, all that stuff, that's when we're going to be looking to buy the dollar. And with that, it's everything I wanted to and intended to discuss tonight. So I'll wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.